You are listening to The Vocal Technologist. Spoken tech for your ears.
So, if you've been watching the capital markets lately, you are witnessing, well, just an extraordinary moment of financial technology triage. Really feels like it. The old scattershot approach to investing, it just seems dead. What we're seeing now is strategic contraction by the giants and, like, at the same time, these massive, almost reckless bets in really specific areas.
That's exactly the dynamic we're here to analyze today. Basically, our goal is to dig into the recent moves by the big financial players, the VCs, to really understand where that capital is actually flowing.
Right.
We've kind of pulled out two central themes from all this activity. First, this huge high-stakes drive to build AI infrastructure, the plumbing of the next economy. And second, the competitive fire that's just heating up consumer fintech. It's forcing innovation everywhere, from digital credit to, well, global banking ambitions. We want you to walk away with a really crystal clear sense of the biggest shifts happening right now.
Okay, let's jump right in then. The most dramatic news signaling this shift has to be SoftBank. I mean, this is the name we associate with giant, sometimes maybe over-optimistic bets.
Definitely.
Now, the Vision Fund is slashing nearly 20% of its staff. That's over 300 people. A really clear downsizing. When a whale that size starts shedding weight, what's the strategic thinking there?
Well, it signals a complete change in Masayoshi Son's playbook, really. He's ditching that fund everything model and going back to his roots, high risk, high reward. And the layoffs, they aren't really a sign of failure, actually. They follow SoftBank's best quarter since 2021. It's more like a restructuring designed for extreme focus. They're shedding the broad stuff to concentrate on just a handful of enormous foundational AI plays.
So getting lean on staff, but spending unprecedented amounts of money on the build-out itself.
Absolutely. We know they've already poured, $9.7 billion into OpenAI. But the bigger story, I think, is SoftBank backing Sun's immense $500 billion Stargate U.S. data center project.
$500 billion. Wow.
Yeah. And this isn't just building server farms. It's a deliberate, $500 billion attempt to anchor the entire AI ecosystem, from chip design to processing around their subsidiary arm and their partner, NVIDIA.
Right.
It's basically a move to own the physical rails that intelligence runs on, not just rent them out.
That's a fascinating and, frankly, pretty risky vertical integration play. And we're seeing that kind of ruthless efficiency translating into, well, internal labor stuff across the AI landscape too, right?
We are, yeah. Look at XAI. They recently cut 1/3 of their data annotation workforce, got rid of most of those generalist AI tutor roles.
The Grok trainers.
Exactly. The people training the Grok model with feedback. The market is just demanding efficiency now. If a task can be automated or outsourced more cheaply, it is. The capital is flowing to the infrastructure, not necessarily the, labor-intensive training models anymore.
Okay, so that focus on foundational infrastructure. It leads us straight to a really great counter-narrative. Stripe. Amidst all this cutting and pivoting, Stripe's valuation has just surged, a record $106.7 billion.
Yeah, it's huge.
That's even higher than its, famous 2021 peak of $95 billion. What makes Stripe so apparently immune to all this volatility?
Well, Stripe is basically the definition of stable foundational value in this space. When the application layer, all those quick burn startups built on top of the payment system gets shaky.
Right.
The core infrastructure that enables all those transactions, that becomes even more critical. That $106.7 billion, it signals that VCs and the market believe, look, no matter which consumer app wins or loses, the money's still going to flow through Stripe. It's just a massive vote of confidence in the resilience, the enduring necessity of those core payment rails.
Okay, so if the underlying plumbing is worth over $100 billion, it's definitely worth asking. What kind of competition is being built on those incredibly stable foundations? Let's turn to the consumer battlegrounds. Competition seems fierce in digital currencies and also alternative credit.
Oh, the stablecoin space is a total war zone right now. Seriously. JP Morgan analysts are openly cautioning that Circle's USDC is facing intense pressure. You've got Tether getting its USAT stablecoin ready.
Which is designed to be compliant, right?
That seems key.
Exactly. US compliant. That's a significant differentiator in a market that's historically been, let's say, weary of regulation. Plus, you have new tokens popping up, like Hyperliquid's USDH. And crucially, major platforms like Robinhood and Revolut are actively exploring their own stablecoin products.
Wow. That level of saturation, it sounds almost deeply problematic. Why are analysts suggesting it's basically a zero-sum game?
Because right now, the U.S. stablecoin market is essentially just fighting over the same pool of existing crypto dollars. Unless the whole crypto economy suddenly expands massively, multiples of what it is now, one company's gain is pretty much another's loss.
Makes sense. And Circle's defensive move really shows how serious this is. They're building their own blockchain arc. It's designed not just for speed, but specifically to handle all the cross-jurisdictional and regulatory complexities you need for global adoption. They're trying to make their product indispensable.
Okay, so while stablecoins fight for digital dollar dominance, Block's Cash App is taking a huge bite out of the traditional credit card market, but using a different angle. Buy now, pay later.
And they are executing brilliantly, especially at scale. Block's Cash App debit card, it successfully enrolled, 1 million users into its post-purchase BNPL feature, and that's just since launching in February.
1 million users that quickly.
Yeah. The growth is the real headline here. Their lending run rate has hit $2 billion annually. That's crucial because it means Cash App is really transitioning, from just being a P2P payments app into a legitimate next-gen credit card. It appeals especially to younger users who want flexible credit without all the historical baggage of, traditional banks.
That domestic scale is certainly impressive. But Revolut seems to be thinking way beyond just one country. They're really trying to become the first truly global financial entity, aren't they?
Oh, absolutely. Revolut is making a massive, globally scaled investment, $13 billion to accelerate its push into new geographies.
$13 billion.
Their stated ambition is enormous, serving 100 million customers across 100 countries by 2030. The CEO, Nick Storonsky, he's made it clear. The aim is to transform Revolut from just a successful fintech into the world's first truly global bank. That capital, it's going toward licenses, infrastructure, localized product launches, everything worldwide.
Okay, now let's pivot a bit. Let's move away from the consumer apps and look behind the curtains. We've talked infrastructure, consumer products. But maybe the biggest efficiency push is moving right into the finance department itself. We're seeing software turning standard financial workflows into what some people are calling digital coworkers.
Exactly. This is the agentic AI wave hitting the back office.
Yeah.
It's moving past simple chatbots into, genuine decision-making and task automation. Agentic AI is designed to observe a multi-step task, like processing an expense report, handling an invoice, and then execute that task autonomously, often across multiple systems.
So less like a calculator, more like a very fast junior staff member.
That's a good way to put it. Highly specialized, very fast, and companies are pouring massive money into that concept.
Right.
AppZen, which focuses specifically on this area, just secured $180 million to scale its platform. It automates entire finance workflows, expense management, accounts payable for over 500 global enterprises already.
Wow.
The value proposition for CFOs is super direct. Cut fraud, ensure compliance, and crucially, scale operations without constantly needing to add physical headcount.
And this automation, it's moving into the really headache-inducing parts of finance too, right? Like compliance.
Oh, yeah. Compliance is AI's perfect target. Take Numeral. They raised $35 million specifically to automate complex sales tax compliance, determination, filing, remittance across the U.S., where state rules are just constantly changing. AI is almost becoming required just to handle the sheer complexity that used to need armies of specialized tax accountants.
And this capability isn't just being sold by startups. The big financial institutions are building it into their own systems, their own DNA.
Citigroup is a prime example of that internal integration. They're piloting these agentic AI capabilities for 5,000 staff right now within their own proprietary platform stylus workspaces.
5,000 staff.
Yeah. The goal is pretty transformative, allowing staff a complete complex multi-step tasks that cross all these different internal systems, maybe accessing a client database, verifying compliance, drafting a response, all from a single prompt.
Okay, if they actually roll that out successfully,
Yeah.
what kind of time saving are we really talking about? Like what used to take 5 minutes now takes 5 seconds. Is that the idea?
That's precisely the idea. If a task requires an employee to navigate, say, 3 or 4 different internal screens, copy-pasting data, then checking a compliance guideline, yeah, that's maybe 5 minutes of cognitive load, easily. Agentic AI aims to reduce that to a near-instant, reliable execution based on just a natural language instruction. The ROI is measured in millions of staff hours saved annually. And maybe more importantly, a massive reduction in human error.
But hang on, all this AI, it needs data, right? And the access to that raw consumer financial data seems to be becoming a real point of friction.
Yeah, this is a major structural change happening right now. Plaid, the backbone connecting countless fintech apps to bank accounts, they struck a new agreement with JP Morgan Chase. And it now introduces fees for accessing consumer financial data.
Fees.
Yeah,
Now significant.
It is. Fintech trade groups immediately pushed back, basically blasting the fees as anti-competitive. Their big concern is that if data access suddenly becomes expensive, it fundamentally changes the economic model for every small fintech built on Plaid's rails.
Yeah.
It could really threaten consumer choice by potentially only allowing the large, well-funded companies to afford that access.
That fee introduction.
Yeah.
Yeah, that's a fascinating move toward controlling the data layer itself. Okay, let's finish up with some rapid examples of market integration and ecosystem expansion. What else is happening?
Well, on the consolidation front, you've got FIS, a massive processing firm, acquiring the Chicago-based fintech Amount. This basically strengthens FIS's digital deposit and loan origination capabilities. It really underscores their strategy to accelerate digital transformation for their existing, often legacy financial institution clients, making sure they can offer robust cloud-native services.
Okay, and new players are still managing to get capital, though, to create specialized platforms.
Yes, absolutely, especially specializing in co-branded products. Cardless, for example, raised $60 million to scale its platform. They power custom credit cards for clients like Coinbase and Qatar Airways.
An interesting niche.
Yeah, and they're targeting $150 million in annualized revenue by mid-2026. They're competing directly with banks in that co-branded space by offering supposedly better integration and higher rewards.
We also saw a pretty significant high-end retail integration with AN, didn't we?
We did. Agen finished integrating its unified payments platform across nearly 50 LVMH maisons. That's over 1,000 stores worldwide, major fashion, beauty, jewelry houses. And this isn't just about speed. It includes features like tap to pay, and it's really designed to simplify reconciliation across a massive, complex, global retail empire. Allows sales staff to focus on the customer, not the payment logistics.
Right, streamlining the experience. Finally, let's wrap up with a kind of memorable, consumer-facing innovation that seems to tie travel, loyalty, and modern tech together.
Yeah, American Express launched a dedicated travel app. It combines booking, rewards, real-time features like, lounge wait times. But the unique kind of modern twist is this digital passport feature. It actually issues NFTs tied to specific destinations you visit.
Wait, NFTs for traveling, is that just like marketing fluff, or does it genuinely solve some kind of pain point for the high-end Amex traveler? What's the angle?
Well, it's definitely smart marketing for sure, but it also taps into that growing consumer desire for, digital ownership and status signaling. It transforms a trip into a sort of collectible achievement, giving the traveler a token, a verifiable experience tied to their membership.
Huh, a digital collectible for your trip.
Exactly. It adds a modern, maybe desirable layer to traditional travel rewards, could create a stickier loyalty program, especially appealing to the more digitally native consumer.
That ability to make loyalty tangible through digital ownership. Yeah, that's certainly something to watch. Okay, so wrapping this all up, what does this mean for you, the listener, trying to navigate this landscape? We've seen SoftBank centralizing capital into massive infrastructure bets, Stripe's core value soaring, data access becoming a priced commodity.
Yeah, the overriding theme here really seems to be control. The market is rewarding platforms that are deeply integrated, highly automated, and frankly, very capital intensive. The era of easy money just funding generalized growth, that seems to be over. Now, success is measured by who controls the core payment rails, who controls the AI infrastructure, and increasingly, who controls the data access.
Right. And that leads us to the final, maybe provocative thought for you to consider.
Yeah.
Given these massive capital shifts, is the financial technology market moving toward an era of just inevitable centralization?
Yeah.
Will only the deeply integrated giants, the ones controlling the data and the infrastructure, the SoftBanks, the Stripes, the JP Morgans, will they ultimately survive and dictate the terms? Or will smaller, highly specialized, vertically focused solutions like Numeral for tax compliance, or maybe those specialized BNPL plays from Cash App, will they still be able to carve out sustainable, profitable niches against this coming wave of enormous integrated platforms? Which model ultimately wins the race for efficiency? The giant conglomerate or the specialized agent? Something to think about.
Spoken Tech for your ears.